Welcome back to the deep dive. This session is really for you, the learner who's ready to move past the noise. I mean, chasing that minute-to-minute volatility, it's a losing game.
It really is. The real edge, the large positional profit, it comes from seeing the market through a much higher time frame through an institutional lens.
And that's exactly what we're digging into today.
Yeah, we're pulling the key ideas from the 2016 ICT Private Mentorship, specifically month 5, which is all about scaling out and understanding these huge macro price mechanics.
So our mission today is to basically give you the structural blueprint.
That's it. We're connecting the long-term why, things like global intermarket drivers, seasonal timing, with the specific how.
The how being
Yeah.
how price is actually engineered.
Exactly. How it's engineered using specific institutional price points, what are called price delivery arrays, these algorithmic look-back periods.
Okay, let's unpack this institutional view then. You always say the market isn't random chaos, but it's engineered. Can you just quickly reestablish that core principle for us?
Absolutely. The central mechanism is, well, it's the cyclical movement of price. It's always designed to move between two extremes.
Premium and discount.
Premium, the asset is expensive, and discount, where it's cheap. And right in the middle, you have equilibrium, the 50% midpoint. This movement isn't random. It's controlled, it's deliberate.
And its goal is what?
Its only purpose is to efficiently clear out liquidity that's resting at very specific levels.
Yeah.
But the key, the prerequisite for getting into these larger moves is submitting to the agreement of two things: time and price.
You have to wait.
You have to wait for the analysis to come to fruition within that cycle.
That concept, time and price agreement, that feels crucial. So the institutional goal is to move price from one of those extremes to the other.
Yeah.
And by aligning with that, you minimize the risk of getting stopped out too early.
Correct. If you understand the long-term order flow, you're riding the wave instead of trying to surf the ripples.
So to begin, we have to calibrate the chart. First step, that means we're establishing the current high time frame, or HTF, trading range. We're talking monthly or weekly charts here.
Right. From an old high, which is your premium, down to an old low, your discount.
And once we find equilibrium, we start watching for the stops to be cleared. Now, here's where it gets really interesting for me. Price targets liquidity at these specific institutional reference points, you called PDAs.
Premium discount arrays, or PDAs, yeah. And you should think of these PD arrays as the institutional roadmap. They follow a very specific hierarchy.
A hierarchy.
Yes, and that dictates where the smart money is most likely to move next, especially when price is hovering around that equilibrium point, getting ready for a major swing. Knowing the order tells you which level to focus on.
Okay, walk us through that hierarchy. Let's say price is at equilibrium and it's targeting an old high. Which arrays does it hit first?
We look at the nearest institutional reference points in sequence. The first priority is always the highest level of liquidity,
Which would...
the old high-low. That's the ultimate destination for buy stops or sell stops. Second, we look for evidence of a sharp reversal. You'll often see this in a rejection block.
What's a rejection block exactly?
It's the price level just above the candle's body, especially when you see these long, powerful wicks. It suggests price was, forcefully turned back.
So the absolute boundary of the range comes first, followed by signs of a strong institutional pushback.
Precisely. Third, and this is critically important for a lot of traders, is the bearish or bullish order block.
The last opposing candle before the move.
Exactly. The last up candle before a big down move, or vice versa. It represents the original institutional accumulation point. After that, we start looking for market inefficiencies.
Inefficiencies like gaps.
Yes. Number 4 is the fair value gap. It's a range of, inefficient price delivery that the algorithm will often return to very quickly to balance things out.
Why do those gaps matter so much to an algorithm?
Because the algorithm is fundamentally designed for efficient price delivery. A fair value gap, or even worse, a liquidity void, that's our 5th point, a huge fast move with almost no pullback, is a sign of, imbalance.
And it has to be corrected.
Price must return to those levels to balance the books before the next major directional push can happen. The others, like the breaker and the mitigation block, they come later. But the initial push is always about clearing liquidity at the extremes and filling those gaps.
That's a phenomenal amount of structure. But, these daily moves, they don't happen in a vacuum. We need context.
You always need context.
We have to talk about the forces that set the directional wind intermarket analysis. We have to monitor the relationships between 4 key asset classes.
Bonds and interest rates, commodities, the stock market, and currencies. This is your directional bias checklist. If you're looking at a position trade, You need global consensus.
And the relationships are pretty straightforward.
They are. Bond prices and stocks, they generally share a positive correlation. They tend to move together. Commodities, on the other hand, move inversely to bond prices.
So we're looking for confirmation. If bond yields start rising, which means bond prices are falling, what does that signal for commodities?
It signals that commodities are typically being pushed up. So if your trade idea involves, say, a strong dollar, and you see bonds agreeing with stocks and commodities confirming that move in the inverse.
You have three witnesses all pointing in the same direction.
You have three strong witnesses. We call that confluence. You use these macro factors to confirm a trade idea. And if you get 3 out of 4 aligning, you have a high probability context.
I think for a lot of people, the hardest part of this is submitting to time. We can't predict the future, but seasonal tendencies give us a guide for when to be patient. How do you integrate time into this?
We use seasonal data, like historical tendencies for currencies. Think the Canadian dollar or the New Zealand dollar, as a directional bias tool and, crucially, as a timing guide.
It's not a prediction then.
No, not a crystal ball. It just helps manage your expectations. The market often follows these intermediate-term price swings every 3 to 4 months, which are tied to quarterly cycles.
Can you give us a tangible example of one of those quarterly shifts?
Sure. If we look at the New Zealand dollar, historically, it tends to make significant intermediate lows, so bullish shifts around specific quarterly windows, March, April, June, July, and again September, October.
So if your other analysis is bullish on the NZD,
Right. If your intermarket and interest rate analysis is bullish, you now know your high probability entry window is likely approaching in one of those 3-month cycles. We also blend in central bank interest rate differentials, higher yields supporting the currency with that seasonal window. It's this holistic view that justifies the patience you need for position trading.
okay, let's transition to the engine running the whole show. This institutional price action, which is engineered to clear liquidity, operates under the rules of the interbank price delivery algorithm, .IPDA.
IPDA, yeah. And that's the key. The IPDA algorithm is coded to look back and cast forward using very specific trading day periods.
And what are those periods?
It's 20, 40, and 60 trading days from a major structural shift. If you know these ranges, you know exactly where the market is programmed to hunt for liquidity.
So what does this actually mean for you, the learner? If the market is controlled by this code, where are those critical liquidity pools located?
The simplest, most direct application of this is knowing that the market is constantly engineered to seek out buy stops resting above the highest high.
Or sell stops below the lowest low.
Right, established within the last 20, 40, or 60 trading days. These are, well, they're mandatory targets.
Yeah.
When you look at your daily chart, those specific highs and lows define the next move.
So if the market is hunting those specific highs and lows, how do we identify the highest probability institutional swing point? The one that signals the big move is actually starting.
You're looking for a clear shift in institutional behavior. And the most reliable signal is what's called the breaker swing point.
The breaker?
Think of the breaker as the market executing a massive feint. Price will first make a short-term high, then it aggressively runs the previous high to clear out all the resting liquidity.
Knocking out all the stops.
Knocks out the stops, and then immediately and forcefully, it breaks the internal market structure by taking out the short-term low it just created.
That aggressive breakdown signals, okay, the job of clearing stops is done, the real direction is now revealed.
Exactly. The return to that structural breakpoint, the point where market structure was first invalidated, that becomes your high probability entry. The market doesn't need to retrace all the way back because the liquidity job is finished.
And the alternative is a failure swing.
The alternative is the failure swing. That's when the market retraces off a key level, but without fully breaking that structure. It offers a secondary opportunity, but really, the breaker is the one that shows true institutional confidence.
This whole framework requires combining all these layers of information. So the progression is find your seasonal or rate bias.
Step 1.
Confirm it with intermarket analysis. Identify your high time frame PD array target on the monthly or weekly, and then you execute and manage on the daily chart.
That's the sequence.
For the learner, then, the most crucial next step has to be getting comfortable with actually calibrating the chart to see what the algorithm sees.
That's the homework.
Yeah.
You have to start seeing the market through the eyes of the IPDA.
Okay, so tell us what that calibration process looks like step by step.
Action 1. Calibrate your chart. On your daily chart, you need to identify the most recent, significant quarterly shift, that intermediate high or low that kicked off the current 3-month directional bias.
Okay.
You have to roll your chart back to the first trading day of the calendar month that shift happened in. That date becomes your anchor point for the next cycle.
And that sets the starting line for the algorithmic data ranges.
It does, which leads to action 2. Map the liquidity targets. From that anchor date, you look back exactly 20, 40, and 60 trading days. You mark the highest high and the lowest low within each of those 3 ranges.
And those specific price points?
Those are the next most likely buy stops and sell stops that the IPDA algorithm is going to reach for. You can use these levels to define your risk or your objectives.
So that's mapping the target zone. Now, the final and probably most critical piece. Position trades need wide stops to survive. How do we manage risk without getting shaken out?
Action 3. Trailing stop management. You have to respect volatility. First, risk no more than 1% per position. That's non-negotiable.
Right.
For your initial stop loss, you trail it wide. You must keep it above the highest high or below the lowest low in the last 40 trading days.
40 days. That seems very wide.
It is, but this wider stop, which is based on the IPDA lookback, is your shield. It prevents the typical volatility, which rarely extends beyond that 40-day range unless a major shift is happening, from knocking you out of a good trade.
So the 40-day stop is designed to ride out the manipulation that takes out the shorter-term stops. When do we tighten it to lock in profit?
You tighten it based on your progress towards your target. Once the trade moves 50% of your anticipated monthly or weekly range in your favor, you maintain that 40-day stop. It's still early.
Okay.
However, once your trade reaches 75% of the anticipated long-term range, so the move is maturing, it's getting close to a high time frame PD array objective, you must tighten that stop loss immediately.
And tighten it to what?
You tighten it to the highest high or the lowest low in the last 20 trading days. This uses the algorithm's focus on that shorter data range to protect you against a potential reversal right near your target.
This framework, it really provides a comprehensive structural guide. I mean, from the global driver setting the win to the institutional roadmap defining the targets, and finally, the specific algorithmic windows that define your entries and your risk management.
It does.
It requires patience, submitting to time and price, but it gives you clarity.
If you know the algorithm is coded to seek liquidity within the precise constraints of the 20, 40, and 60-day trading ranges, and you manage your risk with a trailing stop that respects those specific look-back periods, you're trading on the exact same information used by major institutions. You are no longer guessing.
It removes the guesswork.
So the question becomes, why would you ever let emotion or a tight arbitrary stop dictate your outcome again when you now have the institutional blueprint for market movement?